Three things just happened in less than 48 hours. The CME halted silver trading during a volatility spike. A 3-month compression pattern reached structural exhaustion. And a fresh JPMorgan desk report quietly reframed positioning risk in the futures complex. Individually, none of these make headlines. Together, they form a signal. Silver doesn't halt randomly. Exchange halts are circuit breakers, mechanical responses to disorder. When they trigger, it means order flow overwhelmed liquidity at a specific price band. That is not retail noise. That is structural imbalance. Now, layer that over the chart. For 3 months, silver has coiled inside a tightening range. Lower volatility, declining volume on pullbacks, rising open interest into consolidation. That is not distribution behavior. That is positioning behavior. Meanwhile, institutional commentary shifted tone. JPMorgan's latest desk note didn't scream short squeeze. It didn't need to. It highlighted tightening liquidity conditions in specific maturities, elevated call skew, and sensitivity to delivery month positioning. Translation: small sparks now travel farther. Mainstream coverage treats these events separately. A volatility halt, a technical breakout attempt, a bank research note. But markets don't move because of headlines. They move because of structure. And structure is tightening. Here's what matters. When a market compresses for months, while open interest rebuilds, when physical premiums stop collapsing despite price dips, when call option volume rises faster than put protection, and when an exchange halt interrupts price discovery during that exact window, you are not looking at randomness. You are looking at stress accumulation. By the end of this analysis, you'll understand why this is less about a price target and more about regime transition. Why the 3-month pattern is not just technical, it reflects positioning beneath the surface. Why the CME halt may have exposed something about liquidity depth. And why institutional players are repositioning quietly, not loudly. This is not about silver going to a specific number tomorrow. It's about whether the plumbing of this market is approaching a pressure threshold. Policy backdrop, dealer inventories, futures leverage, options gamma. All of them are aligning in a way that rarely happens cleanly. When silver moves during these moments, it doesn't grind. It reprices. Let me show you why. Policy, government action. Start with policy. Because policy sets the liquidity environment that metals trade inside. Over the past quarter, central bank signaling has shifted from aggressive tightening to cautious stabilization. Not easing, but slowing the pace of restrictive escalation. Real yields remain elevated relative to the past decade. That matters because silver competes with yield-bearing assets. When real yields rise sharply, precious metals typically face headwinds. But when yields stabilize at high levels while fiscal deficits expand, something different happens. Liquidity becomes uneven. Government borrowing increases. Treasury issuance absorbs capital. Banks become more selective. In that environment, volatility sensitivity rises. Now, add geopolitical trade friction and industrial policy. Silver is not just a monetary metal. It is a strategic industrial input. Solar manufacturing expansion, grid infrastructure upgrades, defense electronics, AI hardware supply chains. Industrial demand is structurally higher than it was 20 years ago. So while monetary policy is restrictive, industrial policy is stimulative. That divergence creates cross-currents. Here's why that matters. When policy tightens liquidity broadly, but industrial consumption remains firm, physical supply buffers shrink quietly. Scrap flows slow. Mining capex lags. Exploration budgets don't expand overnight. Silver production growth is relatively inelastic in the short term. So policy creates volatility in paper markets. Industry creates demand in physical markets. When those forces collide, futures leverage becomes the pressure point. That is the environment silver is trading in right now. Not crisis, not calm, tension. Corporate earnings / miner signal. Now look at the miners. Because miners often tell you what spot price doesn't. Recent earnings from primary silver producers show something subtle. Revenue per ounce realized has not always matched benchmark spot highs. In some cases, realized pricing lagged intraday spikes. Why? Two possible explanations. First, hedging. Some miners hedge forward production to stabilize cash flow. If price spikes quickly, realized revenue can trail spot due to prior forward sales. Second, timing and concentrate contracts. Some silver is sold as byproduct within base metal streams. Pricing formulas can reference trailing averages rather than real-time spot. Which explanation is more likely? It's probably a mix. But here's the signal. Margins have stabilized despite volatile spot prices. Costs per ounce are not collapsing. Energy remains elevated. Labor remains tight. That means new supply expansion is not aggressively incentivized. If miners were realizing extraordinary margins, we would see aggressive guidance upgrades and capex expansion plans. We are not. Instead, we see cautious capital discipline. That suggests producers do not view current price levels as sustainably euphoric. At the same time, they are not signaling distress. That middle ground is important. It implies supply is not surging to meet potential demand shocks. In other words, the production response function is slow. When futures positioning expands against slow supply elasticity, volatility amplifies. Physical market evidence. Now shift to the physical layer. Dealer reports show intermittent tightness in specific product categories. Retail premiums are not exploding, but they are not collapsing either. Shipping delays have appeared episodically during volatility bursts. Industrial buyers continue locking medium-term supply contracts rather than relying entirely on spot procurement. International pricing divergence has widened briefly between Western futures benchmarks and certain Asian physical markets during stress windows. None of these alone scream shortage, but together they suggest steady draw. Silver is consumed. Unlike gold, a large portion of silver demand is industrial and not easily recoverable. Solar panels do not melt back into bars. Electronics scrap recovery is slow and inefficient. That consumption dynamic matters when futures open interest expands. Because futures contracts represent multiples of annual mine production in notional terms. If even a small percentage of contract holders decide to stand for delivery during tight windows, logistics matter. Registered inventory versus eligible inventory becomes relevant. The physical market does not need to run out to experience stress. It only needs to experience mismatch. Derivatives, futures, options pressure. Now, the derivatives layer, open interest, has been rebuilding during this 3-month consolidation. That means more contracts exist, more leverage, more exposure. But registered inventory in exchange warehouses does not scale linearly with open interest. This is normal. Futures are primarily financial instruments. Most contracts are rolled or closed. But here's where options enter. Call option volume has increased at out-of-the-money strikes. When price approaches those strikes, dealers who sold calls may hedge by buying futures. That is gamma exposure. If price accelerates into heavy call clusters, dealer hedging can amplify upside momentum. On the downside, if price falls below put-heavy zones, hedging flows can amplify selling. Right now, positioning data suggests asymmetry toward upside convexity in specific maturities. Not extreme, but meaningful. Now, consider delivery math. Not all open interest stands for delivery. Historically, only a small percentage converts. But during periods of narrative shift policy uncertainty, currency volatility, geopolitical tension, delivery interest can spike temporarily. If open interest is large relative to registered stocks, even a modest increase in delivery demand can create headlines. Probable scenario? Most contracts will roll. Likely scenario? Volatility increases around first notice days. Theoretical extreme? Short-term scramble for warehouse warrants. We are not in confirmed extreme territory, but the ingredients for episodic stress are present, connecting all threads. So connect it. Policy has tightened liquidity, but stimulated industrial investment. Miners are disciplined, not aggressively expanding. Physical markets show steady, non-panic demand. Futures open interest has expanded into compression. Options positioning creates convexity pockets. Then, a CME halt interrupts trading during a volatility burst. That halt is not the story. It is the symptom. The story is structural tightness beneath calm surface trading. Markets reprice when three things align: positioning concentration, liquidity fragility, narrative catalyst. We now have the first two. The third can arrive from anywhere: a policy comment, a geopolitical escalation, a surprise data print. When it does, the 3-month compression resolves. Not because of hype, but because leverage must clear. Silver historically moves fastest during regime shifts, not during stable trends. The question is not whether silver goes to a specific number tomorrow. The question is whether this market is transitioning from passive range to active repricing phase. Evidence suggests we are closer to transition than continuation. But transition does not mean straight line. It means volatility. It means failed breakouts before real ones. It means shakeouts before expansion, which is why the CME halt matters. It revealed how quickly liquidity thins when stress hits. And that is the tell. Let's distill this. A volatility halt during a compression phase. A 3-month positioning build beneath declining realized volatility. Measured but firm industrial demand. Options convexity leaning upside in key maturities. Those are the 4 strongest signals. Individually, manageable. Collectively, combustible. Over the next 6 to 24 months, the trajectory of silver will likely be defined less by daily headlines and more by structural liquidity cycles. If real yields gradually decline while fiscal deficits remain elevated, metals gain tailwind. If industrial demand continues expanding through electrification and defense supply chains, baseline consumption tightens buffers. If futures leverage remains high relative to warehouse stocks, episodic volatility becomes more frequent. But risks remain. A sharp global slowdown could suppress industrial demand. A sustained surge in real yields could pressure speculative positioning. Exchange rule adjustments could dampen delivery stress. Nothing here guarantees vertical price action. What it suggests is sensitivity. The system is more reactive now, which means positioning discipline matters. Time horizon matters. Understanding structure matters. Silver does not telegraph regime shifts politely. It compresses. It frustrates. Then it moves. Whether this becomes the final move or simply the prelude to a larger cycle depends on macro variables still unfolding. But the alignment we're witnessing is not random noise. It is structural tension. And structural tension eventually resolves. The only question is who understands the mechanics before it does. Because in markets like this, the edge does not go to the loudest voice. It goes to the most prepared one. Watch liquidity. Watch open interest versus inventory. Watch policy tone. The next phase will not begin with a headline. It will begin with imbalance. And imbalance is building.